If you think you can't get approved for a mortgage because your credit score is too low, I want you to watch this entire video before you make any final decisions. I've personally seen borrowers get approved with scores of in the 500s, and I've seen people with scores over 700 get denied. So today, I'm going to explain exactly how mortgage approvals really work. And when your credit isn't perfect, it's okay. And also, I'll go ahead and explain exactly what determines whether you qualify or not. My name is Joseph Correa, and I'm a licensed mortgage broker and founder of Finibi Mortgage. And I analyze loan scenarios every single day. And one of the biggest myths in lending is that the credit score alone determines the approval. And it doesn't. It really doesn't. A lot of people are confused when it comes to that. That's just one of the factors. And a lot of times that can be overcome. Underwriters don't approve loans based on a single number. They approve based on risk layering. That means they evaluate your entire profile, your income, your debts, payment history, assets, job stability, and documentation consistency. Once you understand this, you stop trying to fix your score blindly and start improving the factors that actually matter. Let's start with something most people don't know. Your credit score is only a summary, not a decision. Underwriters don't just see your score, they see your full credit report. They see your payment history, balances, account types, age of credit, and recent activity. Yes, recent activity. This can be a big one. That means two people with identical scores can be evaluated completely different. For example, someone with a 620 score who has consistent payment history and low balances may be considered lower risk than someone with a 680 credit score who has recent late payments or high utilization. So instead of saying, what's my score? The better question is, how does my profile look to an underwriter? That's the question professionals ask. Now, let's talk about low credit scores and why they don't automatically mean denials. What matters is why the score is actually low more than the actual score. There are three main categories. Either you have thin credit history, which basically means you don't have much credit history. You have high balances based on what your credit limit is. So if you have a limit of $5,000 and you owe $4,900, that means you have a high balance. And any negative events that appear on your credit report. Thin credit history can actually be easier to approve than bad credit history, believe it or not. Someone with limited credit may still qualify if the rest of their profile is strong. High balances can often be fixed quickly by paying down accounts strategically or by moving balances from one credit card to the other. Now, when it comes to negative events like collections and late payments, these require a little bit more of an explanation and probably some documentation that you need to provide so that the underwriter can understand exactly what's going on. But they don't automatically disqualify you. A letter of explanation and other supplemental documents can be just enough to get you approved and moving on with your loan and even closing. In fact, many loan programs are designed specifically for borrowers with low scores. The key is knowing which programs actually fit your profile. Now, let's talk about the next one. Here's a mistake I see constantly. Someone wants to improve their credit before applying. So they rush to pay off collections or close accounts, but they do it without strategy. And sometimes that actually lowers their scores temporarily, which affects the loan decision, obviously. So why does that happen? Well, because credit scoring models react to sudden changes. And these credit scoring models are basically Equifax, TransUnion, and Experian, which are the three bureaus that determine your credit scores. Closing accounts can reduce your available credit. Paying off certain debts can shift your utilization ratios. And yes, timing does matter. This is why professionals never recommend random credit actions, which means paying off an account just because, instead of knowing if it actually makes a difference on your credit scores and your credit profile. Every move should be calculated and timed based on your application date. Credit improvement is not just about speed, it's about strategy, okay? Next, let's talk about the fastest ways to improve your approval odds. If your goal is mortgage approval, these are the fastest legitimate ways to strengthen your profile. First, reduce credit card balances. Yes, you got to lower your balances on your credit cards. Utilization is one of the biggest factors in scoring models. Bringing balances below 30% or ideally below 10% can raise your credit relatively quickly. Which, what I'm talking about in plain English, is that if you have a credit card with $1,000 credit limit and you bring it down to only owing 30% of that credit card, which would be $300, or even ideally 10%, which would be $100, can really boost your credit scores quickly and easily. And it's something that doesn't require much effort. Second, avoid new credit activity. I can't say this enough. Don't open new accounts or apply for financing or allow unnecessary inquiries before closing. Mortgage is usually a much higher loan amount than a car or a credit card. So go in the right order. Focus on the biggest loan amount, which is going to be your mortgage. Then after you get approved and you close on your mortgage, then go buy the car you wanted to finance or apply for that credit card you wanted to apply for. Okay. Third, correct reporting errors. Credit reports often contain mistakes. Disputing inaccurate information can improve your profile, and sometimes it can hurt. So it's important to talk to a professional about that. Fourth, build positive recent history. Even a few months of perfect payment history can improve your overall odds significantly. Because yes, credit models, they calculate your credit based on recent activity, okay? So it weighs more than old activity. Paying on time now improves your score much faster. Notice something important here. None of these things that I've mentioned require waiting years. They're short-term optimization strategies. So that's the key. And in a minute, I'm going to show you the exact type of borrower who gets approved even with a low score, because this is where most people misunderstand how approvals actually work. Now let's talk about what underwriters really look for. When an underwriter reviews a file with a low credit score, they don't just focus on the number. They look for compensating factors. Compensating factors are strengths that offset risk. Some examples include strong income stability, low debt activity, savings reserves. Yes, savings reserves. If you have enough money for 6 months or 12 months payments, underwriters will definitely take that into account and weigh your file more positively. Long employment history and consistent housing payments. If you pay on time, that's a big factor, especially when it comes to your mortgage. If a borrower shows responsibility in other areas, underwriters may still approve the loan even if the score is lower. This is why approval is never about one metric, okay? It's about the overall story that the entire file tells. Next, let's talk about program selection and why that matters more than your actual score. Another major factor most people don't realize is loan program selection. Different loan programs allow different credit ranges. Some are designed for higher scores, others are designed specifically for borrowers rebuilding credit. If someone applies for the wrong program, they may be denied, even though they actually do qualify for another one. That's why program selection is critical. Professionals don't ask, does this borrower qualify? They ask, which of these programs gives the borrower the highest approval probability? That's a completely different approach. Now, here's what I want you to take away from this video. Low credit doesn't automatically mean you can't get approved. It means you need the right strategy. Approval is about preparation, structure, and positioning. When your file is structured correctly, your approval odds increase dramatically, even if your score isn't perfect. I've seen borrowers go from thinking that they had no chance to getting approved simply because they finally understood how the process really works. If you want to learn how to analyze credit, structure loan files, and understand approvals like a professional, I teach the entire loan process inside my training programs linked below. And if you ever want me to analyze your situation, comment score with your credit range, and I might break it down in a future video. Don't forget to subscribe if you like this video, and don't forget to like it as well. And I'll see you in the next video.